Hello, live from New York City. I am Stuart McIver from Amvest Capital. Welcome to the Amvest Capital Inc. live webinar with Liberty Gold Corp. Liberty Gold trades on the TSX as LGD and on the OTCQX as LGDTF. We hope you'll enjoy today's program. Our replay will be available on demand following the live webcast. Q&A is a very important aspect of our webinars. Please submit your questions here and we'll try and ask them in real time. At the end of the webinar, please share your feedback here. Amvest Capital is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. This call is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security and should not be relied upon as a basis for investment decisions. Joining us today from Liberty Gold is President, CEO and Director Jason Attu. Following the formal presentation, members of Amvest Capital will ask questions of management. We also look forward to any attendee questions that you send in. And now I'll turn it over to Jason. Thank you.
Thank you, Stu, and thank you, ladies and gentlemen, for joining us this afternoon. Quickly mention our cautionary notes disclaimer, as I will be making forward-looking statements in my presentation today. Having spent my formative years on the investment side of the business, there were always two questions I asked as a prospective banker and a principal investor. The first one being, does the company lay out a coherent strategy? And the second, do the assets and the personnel exhibit the core competencies that align with the strategy? At Liberty Gold, we have both, in that our strategy is clear. Our goal is to become the low-cost producer of choice in the Great Basin of the United States. This is not an aspirational vision, as what I hope to convey today is that Liberty has the right assets, the right address, and the experience and the talent density to generate significant alpha for our investors. So it might be surprising to some that Liberty's global gold endowment is over 8 million ounces, gold equivalent ounces, across our portfolio. Why is this relevant? Given the macro environment around global monetary policy, especially with expectations we will be shortly moving in a more accommodative direction from all the monetary policy leaders across the globe. The trend of and theme regarding de-dollarization and the volatile global geopolitical backdrop that we find ourselves in, I believe we have a trifecta of events that will provide the most fertile environment for gold that I have personally seen in 30 plus years in the industry. A Fed pause largely expected next week should lead to weakness in the US dollar. This reversal of a strong dollar trend, I believe, should be an important catalyst for the gold price. In addition, the diversification away from the US dollar by central banks and the momentum regarding the de-dollarization theme are all very constructive for gold. In fact, I was reading a recent report from the Bank of America, which highlights technical patterns supporting gold prices in the range of $2,000 per ounce to possibly $2,500 per ounce in the very near term. In that same report, they point to the fear of the dollar debasement as another driver of gold demand, as nations look to reduce their reliance on the US dollar by transacting in other currencies. The point being, I believe we will shortly be in a period of significant gold price appreciation, which will continue to provide a very constructive tape for Liberty and its shareholders over the next few years. Liberty and its owners will greatly benefit as we have tremendous leverage to gold, with over half of that aforementioned 8 million ounces in the Great Basin of the USA, which is widely considered the best jurisdiction for gold production globally. Not only are these ounces in the Great Basin, but our two assets being the Black Pine asset in southern Idaho, as well as the Goldstrike asset in southwestern Utah, they are both past producing heap leach mines, meaning that they come with an operational history that we can leverage. In addition, heap leach assets have the lowest technical complexity coupled with the lowest capital intensity. In terms of our capital structure, Liberty has approximately 320 million shares outstanding with no debt, implying a market cap of approximately 150 million Canadian dollars, with a very robust US dollar 16 million of cash as at March 31st, which is sufficient to get through all our work programs this year. In terms of shareholders, we are fortunate to have some of the most knowledgeable gold and resource investors. We are pleased to have the likes of Van Eck, Franklin, Resource Capital Fund, Merck, and Newmont on our register. In addition, I think it's important to point out that management and board are the third largest shareholder at nearly 8%. As most of you know, I joined the company some 7 months ago. Upon acceptance of that role, I made it cross-conditional that my appointment enabled me to purchase a meaningful equity position through a private placement at the prevailing market price. I have additionally and consistently been adding to that equity position and currently have equity exposure of over 3.5 million shares. The point being, with management and directors having nearly 8% of the company, we have significant skin in the game, which enable us to think like owners every day. Not only that, but I have made some significant governance improvements, which are all outlined in our recent management information circular. The one most salient and germane to this audience and worth mentioning here is mandating of a minimum share ownership policy. So all of our directors are required to own 3 times their director fees, 3 times equity in their director's fees. I am required to own 3 times my salary, and all other executives 2 times their salary. So again, we think like owners every day, as we are all owners, which I believe provide strong alignment in every decision in an effort to create more shareholder wealth. We also have a well-known industry respected sell-side analysts that cover our company, all of whom incidentally were on our property just 3 weeks ago for a site visit. I encourage you with access to their research to get their impressions of our project, as it was very well received, and each had positive takeaways that you can read in their publications. Most relevant to the folks on the call here is that these analysts have a mean target price of $1.35, which represents more than a 200% upside from where we are today. So to Black Pine, this is our flagship asset. Access to our project site, you can see right here, is straightforward. As you can see what I've just highlighted, it basically runs across Interstate 84 or I-84. The project is an equidistant 2-hour drive from either north from Boise or 2 hours from the south at Salt Lake. So access and proximity get a check. In terms of geology, Black Pine is a sedimentary rock-hosted Carlin-type gold deposit. As I mentioned before, the property has been the site of previous mining and exploration activities, including some 30 million tons of ore mined, or the equivalent of 450,000 ounces historically produced in the mid-1990s by Pegasus Mining. The system itself is massive, for which there is a known mineralization across at least 7 kilometers of strike distance, as you can see orientating from the northwest to the southeast on the slide. The project was acquired by Liberty some 6 years ago for $1 million. And the team has done a remarkable job of getting the resource endowment to over 3 million ounces. In terms of other favorable attributes, we have power right to the mine gate. There are no unique biological or cultural issues currently identified within the project area. There are no threatened or endangered species. There are no fish-bearing streams. The site is considered by the regulators as a disturbed site, so there are no issues with the project being considered a virgin viewshed. There are also no timber values. In fact, a forest fire burned the whole area some 10 years ago. As well, there is no water in the mineralized area, so there are no issues with mining through water tables nor the generation of pit lakes post the operation. However, there is plenty of water in the basin for which the team has already de-risked significantly ahead of time by securing enough processed water for approximately 100,000 ton per day operation, which for context is more than 2 times the size of the previous operation. Now, we might not get to 100,000 ton per day operation, but it certainly gives us the flexibility to do so if the asset and the economics warrant that. So in summary, in terms of footprint and environmental impact, this project is relatively benign in comparison to other projects in the US and North America. And we think that permitting will be relatively straightforward. I'll come back to that more in a minute. So as I mentioned, the Black Pine project is an oxide deposit with very little sulfides and some organic carbon, which is amenable to low-cost, run-of-mine conventional heap leaching. It's important to note that the oxide resource that we reported in February was at January 21st of this year. We've drilled more than 150 holes since then, and we continue to add holes weekly. There will be some 35,000 to 40,000 meters of drilling that we'll incorporate to an updated resource that we expect end of year. The resource currently is 2.6 million ounces indicated and approximately 500,000 ounces in the inferred category. As I said before, Black Pine is a massive system. In fact, this is the largest oxide mineral endowment that we are aware of in the Great Basin that's not owned by a senior. Importantly, within this resource, there's a high-grade subset of more than 1.7 million ounces indicated and inferred, for which the grade is at or above 1 gram a ton, which really do drive the economics that we'll be putting forward in our upcoming pre-feasibility study. Now, one gram a ton doesn't necessarily sound very high, but for context, operating heap-leach mines, open pit heap-leach mines in the Great Basin, they have an average reserve grade of about 0.5 grams per ton. And so the other attributes that make Black Pine very mineable is the fact that there is a low sensitivity to the heap-leach feed particle size, meaning no crushing required. It is a straightforward run-of-mine operation. The consumable consumptions are low. The proposed pits are characterized as having low silica and high carbonate content, making them non-acid generating and very amenable to more favorable environmental permitting and closure practices. In terms of the mineral resource that I mentioned we put out in February, I'd like to point out the quality of that recent resource. Can't really see it here, but the 84% you see in the bottom indicated speaks to that. So 84% of this resource is indicated, and we're working hard to do enough infill drilling right now to get to at least 3 million ounces in the indicated category, which will set the geological basis up for a pre-feasibility study. With 3 million indicated ounces, this provides, it's our belief that this provides Black Pine with a sufficient size and scale, and it isn't hard to envisage a base operation of approximately 170,000 to 200,000 ounces per year for a minimum of 12 years, which would only expand as we open up more zones. Expansion is very likely as we know there's mineralization throughout our project boundary. We've applied to expand our exploration permit all around the zones that you would have seen in the previous slide, as the mineralization butts right up against our currently approved permit. and we expect to get that approval by the end of the year. The other key item to point out is Rangefront, which sits directly southeast of the Rangefront Fault. Rangefront was only discovered some 2 years ago. It is a testament to the team that this zone now makes up almost 1/3 of our resource, adding nearly 1 million ounces to our inventory. All of which are at a very, very low cost of discovery. These 3.1 million ounces come in from a discovery dollar per ounce perspective of about $16 per ounce. It's exceptionally good. In terms of our work program for this year, we see significant opportunities for resource expansion, including a number of undrilled or sparsely drilled or shallowly drilled areas that surround all the historical pits and lie within soil anomalies that extend beyond the drill tested areas. Areas of shallow alluvial or upper plate cover west of the Rangefront Fault also present targets for our resource expansion. This is why we currently have 3 drills in the field. There's also a significant amount of work being done to convert inferred to indicated. We will advance our geotech, our waste rock characterization, hydrological programs, and finally on metallurgy, we will complete both phase 4 and phase 5 variability composite testing to fill in gaps of our currently drilled resource. We will continue to select metallurgical domain characterization of these composite heads and residues to assist with our project engineering or design and permitting. In summary, with the work program this year, there are no shortage of catalysts for the company over the course of the next 12 months, and we'll be releasing them to the market as the information comes in. On the permitting side, in order for us to get into the federal environmental process, we need to submit what is called a mine plan of operation. This we anticipate in filing next year, which will kick off all the work required to get to a record of decision. I should note, though, that Liberty has front-end loaded a lot of this work, with the bulk of the engineering environmental studies will be completed or vastly completed ahead of the submission to the agencies and regulators. And most recently, unless you've been living under a rock, you would know that there's had been some significant tension leading up to the debt ceiling legislation, which was passed earlier this week. What folks may not be aware of is part of this legislation included a provision that relates to ensuring governmental agencies now have to follow an expedited project permitting process. Most impactfully for Liberty is that under the new law, an environmental impact statement, or EIS, is now prescriptively, it cannot take more than 24 months. And as you had heard from me earlier, we believe that the Black Pine project is straightforward. It's got all the right attributes with no substantive environmental issues that we believe cannot be resolved within that 24-month time period. I think it's also worth mentioning that Liberty has 2 other assets in the portfolio, the TV tower in Turkey and the Goldstrike asset in southwestern Utah. Goldstrike also is a past producing mine and has a resource endowment of approximately 1.3 million ounces in all categories. It does have a published preliminary economic assessment, which highlights an economically attractive mine. Last week, we provided an update on the activities at Goldstrike related to processed water, the land exchange proposal, and most excitedly, the gold recovery from the leach pads. The metallurgical work in particular was the most interesting, as we provided the market a significant amount of data to support our thesis that the historic heaps have tremendous early revenue value, which we have demonstrated there is approximately 70,000 ounces of early stage ore that we could access to really jumpstart the mine. Other work that we updated the market on has to do with our hydrological field work, which is going to commence in a few weeks in an effort to secure the process water required for the operation. And finally, there's been progress made with a potential land swap that I referenced earlier. The Bureau of Land Management and the Utah School Trust and Lands Administration have made significant progress in a land exchange deal, which would include the Goldstrike mineral concessions. And if approved, the ramification, what it would mean, is that Goldstrike would not be subject necessarily to the federal NEPA permitting process. And this would really expedite the overall permitting and approval for construction for the project. In summary, Liberty Gold is a Great Basin focused company with tremendous leverage to oxide gold resources. We have a coherent strategy of de-risking and advancing our properties to become, as I said before, the low-cost producer of choice in the Great Basin. We have the right assets, the right address, and the right people to generate these returns for our investors. There'll be plenty of news flow over the course of the next 6 months, so please do stay tuned. And Susie Bell, who's our Director of Investor Relations, love to sign you up for our updates, our newsletter, so we can keep you better informed of our progress. Thank you for your time, and thank you to the team at Amvest for organizing this webinar. And I'll turn it now back to Stuart. I think we're going to go to a question and answer period.
Thanks for that, Jason. That's great. And yeah, we will now move on to the Q&A portion of the program. And once again, we appreciate audience questions, so please submit them here. Pop it up your screen. And so just quickly on Turkey, what is going on with the TV tower project, and is the monetization of this asset still a focus for Liberty?
Yeah, no, it's a great question. Thank you for that. And just for a refresher for people, TV Tower is a very large copper gold porphyry in northwestern Turkey. It has an endowment of 4.5 gold equivalent ounces. It's a joint venture between ourselves and Teck Resources of Vancouver. We have 70% of the project. They have approximately 70% of the project. They have 30% of the project. And we announced late last year that, given our focus really is Great Basin, that we announced a sales process. We hired a very well-known in that area investment bank called NRG. But what's happened, obviously, since then, and people probably are aware, is that the incumbent president, there's a lot of economic challenges in Turkey right now. And so there was presidential and parliamentary elections that happened in early May. From the parliamentary perspective, President Erdogan, his party did get the parliamentary support. President Erdogan is now got a 5-year term. It did have to go to a runoff, but he did get over the 50% required. So I think that the point would be, up until that time, there was a lot of uncertainty as to what was going to be happening geopolitically in Turkey. And so we purposely took a pause on the process, because more than likely, similar to the other asset sales that we've done in Turkey, there's a group of buyers that are Turkish parties. And without them having the clarity as to what's going to happen from a geopolitical and economic perspective, it was very, very difficult to engage those parties in an asset sale. Now that there's visibility with respect to, again, Erdogan having a 5-year mandate, we're re-engaging and kicking that process off. As I said, it's a very, very good asset. It's just not our focus right now. And if we are able to monetize it, that obviously means it's a very good source of non-equity funds that we can put back into principally Black Pine, but in addition to Goldstrike.
Got it. Thanks for that. And I guess while we're on this map, if you could touch on the Griffin project under option.
Yeah, so again, we don't really talk. So that's we really just have shares associated with that
Yeah.
project right now. So it's really not a meaningful part of our portfolio. It's really early stage, and so there's another group, Fremont, that's moving that forward, and we'll see where that
Yep.
goes.
Great. And then on the kind of the shareholders, let's push this slide. When did Newmont come into the company?
Really good question as well. So this company, so it's a legacy position. Newmont, as I think people recall, a number of years ago, bought a company called Frontier, and Frontier owned the Long Canyon mine in Nevada, northern Nevada. This effectively, the company and a lot of the individuals that are working, specifically the geological team, came from that huge success. And so there was a spinco called Pilot Gold, which now is Liberty Gold, and that's how Newmont picked up it's a legacy position from a corporate transaction over 10 years ago of Frontier. But yes.
Got it. Thanks for that. And then, are you planning to do further metallurgy at both Blackpine and Goldstrike?
So I'll touch on Blackpine in the first instance. Yes, our plan is to do further metallurgy. As I said, we've got phase 4 and phase 5. We obviously need that information on all the various zones and deposits that will feed into a pre-feasibility study. The metallurgical response that we've reported to date is exactly what we expected. We're getting recoveries from a run-of-mine operation that are consistent with both the previous operation, as I mentioned, the operational history, but very consistent with everything that we're doing the test work for. And in fact, the Rangefront zone, which again is a new discovery that we have almost 1 million ounces, actually is providing the best metallurgical responses right here, the best metallurgical response that we've seen in, again, we've got a number of columns, and basically we'll be at a feasibility stage by the time we finish all the met program for this year. But again, that will obviously feed into the recoveries for the pre-feasibility study that we expect to put out to the market around H1 of 2024.
Yep. And we contemplating a PEA on any of the projects or going straight to PFS?
No, we forego the PEA for a number of different reasons. But firstly, and I'm on the right slide, the total resource, as you can see, we've got 84% in the indicated. Our program, the 32,000 meter program we have this year, a lot of it is to convert the inferred into indicated. So we can actually move a lot of our into pre-fees and into reserves, firstly. So the quality of this resource is very good. And if we were to put out a PEA, I mean, we could put one out arguably in 3 to 6 months. Another 6 months later, we'd have a pre-feasibility study. In addition, when we did make that decision, as people can appreciate, we're still very much in an inflationary environment. So going out and talking to vendors around quotes with mine capital and consumables, we don't think it would provide the best reflection of what the asset will actually provide in terms of the economic return, because we are, again, in somewhat more of an inflated environment. We'll see where we get to when we go to do the pre-feasibility study, but everybody that we've been talking to have a complete expectation that there's going to be a de-escalation and there's going to be some disinflation that does happen before, again, we have to start putting in mine capital consumables that obviously will impact the overall capital cost to build this as well as the operational costs.
Got it. Thanks for that. And the question submitted in, not sure which project it applies to, but the resource calculations and sections released to date suggest, in the absence of a feasibility study, that early stage mining will involve a substantial amount of pre-stripping or a significant period of lower than average as mined gold grade and consequent negative impact on project economics. Could you please speak to this issue in some detail?
Yeah, I'd encourage you to go to our corporate deck. This is an abbreviated version because we do in the mineral resource, we actually put a sensitivity table analysis that walks through both cutoff grade and also provides what the waste or what you can infer to be the strip ratio is. And so it's a really good question. We're clearly doing all the mine optimization work now, but for as I said in the presentation, the overall average or reserve grade of assets that are operating right now are 0.5. So the overall resource that we have right now is 0.5 at a 0.2 gram per ton cutoff. At the 0.2 gram per gram cutoff, the strip ratio is about 3 to 1. But as you reduce that cutoff, and clearly it will really be dependent on the margin you can make as you reduce the cutoff. As long as you're making margin, you're going to be putting that material on the heap leach pad. If you got down to a 0.1, and for example, Marigold, which is the asset that SSR runs, just to the south of us in Nevada, and this is a dead ringer for Marigold, by the way. They have a cutoff grade of less than 0.1, it's 0.7 grams per ton. But if we were go to the 0.1, the strip ratio gets right down to 1 to 1. So again, it's not a high strip. There's mineralization everywhere. I think when we optimize the mining scenario, it really will depend on the gold price that we are at the current time, to enable us exactly what strip and what cutoff specifically we're going to be using to mine it. But as I said, as long as we can be making margin, and there's some significant separation between gold price and what obviously our operating costs will be mining at a lower cutoff, we will absolutely do that. But it's a really good question, and what we're doing right now in terms of the optimization is what we need to do, meaning knowing that we are Liberty Gold, a junior developer here, is essentially the mine sequencing optimization that hopefully will get us to a payback of our capital of less than 2 years. And to do that, obviously, we need higher grade, near surface, lower strip material. But give us some time. We're working through that. It's a really good question. But again, at the 0.2 cutoff, which is our base case, we're at a 3 to 1 strip. So it's not a lot of strip associated with an asset like this.
Got it. And then someone asked if you comment on the metallurgy at range front hole 709 and whether you followed up closer to surface.
Oh, I'd have to, maybe if you could get that person's information, we'd have to, I don't know exactly what the metallurgy at 709 would be, and we can get back to him or her with a more specific response.
Will do. And then at either of the Black Pine or Goldstrike projects, are there any indications of any deeper sulfides? Has there been any deep geophysics or deep drilling across the projects?
Again, as I said before, the whole Black Pine resource is very, very low sulfides.
Yeah.
In fact, the majority of this oxide sits between 200 meters and 500 meters, and is within what's called a middle plate zone. So it's highly fractured. It's an oxidized area. Our focus right now is just 100% on the oxides. We do think over time, and as this gets mined out, it's very, very common for oxide deposits like this to have significant sulfide opportunities. And we're not focused on that for a couple of reasons. Again, we've got enough on the oxide, and obviously the sulfide would be deeper. But secondly, and more importantly, in order to do sulfide exploration and elucidation of a resource, you'd have to actually bring core drills in. All of this is primarily produced through RC drills, and core drilling is about 7 times as expensive as RC drilling, firstly, and secondly, any sort of the sulfide optionality or opportunity would require a mill, so it wouldn't be heap leach, so obviously more capital, and it would be at the back end of our mine. And so, as I said, right now our base case is 10 to 12 years of a mine. It's going to grow, we think, from oxides, but certainly there is sulfide opportunity. an optionality with this deposit.
Yep. And on the wider Great Basin, if you could touch on what other major gold miners are operating in the Great Basin?
Yeah, the biggest one, most principal one is the Barrick Newmont joint venture. They have a number of assets in the Great Basin. It is the most prolific in their portfolios. It's a joint venture, as I mentioned. Most of these assets actually started with the oxide operation, and now they're in the deeper sulfide. So it's mines that people would know about, like Goldstrike, and not our Goldstrike, but the Goldstrike in the Newmont portfolio, and a whole bunch of other ones. And so, yeah, there's other operators too. I think immediately of I-80 that's got some really decent and prospective opportunities in Nevada, but their strategy is the sulfide opportunity, not the deeper sulfide opportunity, because they have a mill. Again, what we're trying to do in our thesis is around heap-leach assets. And there's a number of heap-leach assets going in the Great Basin as well, but our thesis is heap-leach assets because, again, the technical complexity is straightforward, and it's a low capital intensity to get and build a company. We do think that the Black Pine asset is a company maker, and why we say that, and I was back at Gold Corp when Gold Corp had the Marigold mine that I mentioned. John Gilligan, who's our chief operating officer, was part of the integration team that when SSR bought it from Gold Corp. So he knows and understands the power of that mine to be a company maker. And as I said before, this is a dead ringer for what Marigold is and continues to contribute to the SSR portfolio. So again, that's another asset, the Marigold, that, as I said, we think is an absolute dead ringer. It's a heap-leach run-of-mine operation. And we think ours is a bit more straightforward because, as I mentioned before, we don't have the water table to deal with. They actually are mining through the water table. In addition, they have a sliding scale royalty anywhere between 7 and 9%, and they're making very, very good cash flow. We've got a 0.5% NSR. So very different. Obviously, they've sunk the capital. We still need to sink the capital. We still need to do all the studies and get through the permitting process. But if you were going to look for an analog, I would, as the group on the line, I'd look at Marigold, and we think Black Pine will be another Marigold in 5 to 7 years or so.
Right. And then what's the budget at 2023, and how is it split roughly across Black Pine versus Goldstrike?
Yeah, so the majority of the budget will be for Black Pine.
Yep.
And as I said, we've got a lot of things going in terms of the work program. Really, the only work that we're doing at Goldstrike is, unlike Black Pine, we still have yet to secure water. Water is a critical attribute in order to have a mining operation. So we're spending money, and we engaged a group called Lachlan Associates that are going out and doing all the hydrological work, including drilling some potential water wells that, again, if we're successful, then we'll have de-risked Goldstrike as well. So there's not a lot of capital going into it. Most of the capital for our work program this year is all around the drilling at Black Pine, as I mentioned, the geotechnical work, the metallurgical work, the environmental baseline work, and everything that we need to do to advance to a pre-feasibility study at Black Pine.
If you could just remind everyone what the royalties were on both projects.
Yeah, so the royalty at Black Pine is 0.5%, so less than 1%. And that came with the acquisition costs, and something very similar, 1 to 2% at 1 to 2% at Goldstrike.
Got it. And then if you could remind everyone, roughly timeline of when you might expect, both projects to commence production, or the target internally.
Yeah, so probably best to go back to this slide here. And so as I mentioned, our big, most consequential aspect or goal that we have is to get to a pre-feasibility study roughly around this time next year. You can see, again, everything that's required to get to a record of decision. As I said, there's been some really good progress, specifically enacted into law around agencies taking more than 24 months once the notice of intent is submitted to the agencies and you start your full-blown draft EIS or environmental impact statement to your final impact statement that can take more than 24 months. So our best guesstimate of getting a record of a decision is H2 2027. And so we can break ground shortly thereafter. If we get, obviously, we need to finance the project. It's not a long build. It's anywhere between 9 and 12 months. So we could be generating cash flow from Black Pine in you know, by 2020, late 27, early 28, or sorry, it's 2028. With respect to Goldstrike, if the land swap does go ahead that I mentioned between the BLM and the SITLA or the Schools Trust of Utah, it's a much more expedited time frame for permitting because I mentioned we wouldn't be through a federal permitting process, and therefore we could, therefore Goldstrike could be the first asset into production for the company. But as I said, the critical de-risking aspect is for us to secure process water. One thing that we can't control, again, is the land swap. If it happens, I think that's just really, really good because, as I said, it's going to compress the timetable to get in our permits, and so it would leapfrog in front of Black Pine. But those are generally the bookends in terms of when we'll actually be in construction and start generating our shareholders some cash flow.
Right. And given the size of the projects, surely it's something of interest to majors at some point.
Well, it's a really good question as well. And what I say is not just the size, because yes, this is obviously the scale and size for a lot of would-be both intermediate and senior producers out there. But I also would say from a jurisdictional perspective, you know, being in the Great Basin, both of our assets in the Great Basin is hugely advantageous. And I just point to, I know there's probably a number of gold investors. Newmont had to halt their stock today because they shut Penasquito down, which is their huge mine, polymetallic mine in Zacatecas, Mexico, because of some of the labor unrest there. Again, we've got such a huge advantage of being in a jurisdiction that is always ranked in the top 1 or 2 in the Great Basin in terms of everything being transparent, no real kind of issues around blockages or blockades, and if you do everything right, we believe, and certainly the majors are operating in the Great Basin, and I would, you know, you can ask them whether they think it's the best jurisdiction, but certainly in our mind is always ranked in the top jurisdictions. I think more and more companies that are looking to essentially acquire assets and replenish their pipeline, Great Basin is going to keep popping out as somewhere where they want to be in a very comfortable address, because again, they know the rule of law, they understand what they have to do, there's really no surprises that can come up. Obviously a stable regulatory regime, and so yeah, it's not just, I think, the scale and the size. As I say, we have the right assets and we have the right address.
Yep. And then a few questions on kind of plans to get more traction in the share price over the next 6-12 months, and minimize any potential dilution that needs to happen over the next few years.
Yeah, it's a good question as well. Look, it's obviously, I think there's going to be catalysts around the gold price, as I started my presentation, which I think is going to be constructive for all the developers out there. what our team is doing is we have our heads down. It's essentially the work program that I described specifically at Black Pine. We're just continue to drill. We're putting those results out to our investors and the market as they come due. We're always providing our continuous disclosure. I mean, we are a developing company. We're obviously in a situation where we're spending money every month. So at some point we will have to finance. What I said at the outset, though, is we got $16 million from our balance sheet, US dollars. We also have about $3 million of illiquid marketable securities. So we're in a much better, more insulated place than a lot of our peers. And the work program we specifically designed for 2023 that we'd be comfortable to get through this year in a comfortable basis and exit in 2023 with some cash on our balance sheet. So that obviously gives opportunities where, again, much more constructive market, just continue to put our news flow out. You know, it's also the opportunity that I talked around the TV tower assets in Turkey. That could be a source of funds that, again, wouldn't dilute our shareholders. We still have to go through, obviously, that process, and we'll see what happens. But yeah, it's obviously, you know, I joined 7 months ago, almost exactly at the price we're at today. We rode up for a bit, we're back down there. And so it's something that's obviously near and dear to myself. It's something that, you know, we're all aligned with our shareholders out there. As I said, we're major. We have major alignment. We have alignment because we're trying to do everything that we can to advance the project. But sometimes you're just in bear markets, and you know, all we can do is put our heads down and do everything we can to de-risk projects and have continuous drills on the property. And at some point, as they all do, this is cyclical. The business is cyclical. It will turn around.
Understood. Well, thanks for that. I think we can you know, move to a close, and don't forget that feedback's important. So please share your feedback with us here. And the on-demand replay will be available in about an hour and a half via the same link that you used to join today's webinar. We hope you'll join us again for future webinars. You can find a full schedule of upcoming webinars as well as a library of previous ones at amvestcapital.com/webinars. Thank you and goodbye. And Jason, if you want to close off with a finishing remark, that'd be great.
No, I very much appreciate everyone's time, ladies and gentlemen. Thank you again to the Amvest team for organizing this webinar. As I mentioned earlier, we have Susie Bell, who I think most of you will know, our Director of Investor Relations. If you have any questions or if you need to get a hold of myself, please just go through Susie. We're always happy to engage and talk with investors, shareholders, and prospective investors. So thank you again for your time, and enjoy the rest of your evening.